And welcome to the Asset Preservation Hour. I'm your host, Randy Major. Joining me today is advisor and owner of Asset Preservation Tax and Retirement Services, Stewart Willis. Hello.
How are you doing?
I'm great, Stewart. How are you?
Ready to do this.
So good to be back with you again this week. We've got a lot to get into. I'd really like to talk about the current state of our economy and, what's going on in the markets right now.
Well, I think what we have to do is separate out those two. The economy and the stock market are two different things because obviously, despite what most people believe is a questionable economy, the market continues to rise. And, the beneficiaries of COVID have been these really ultra large cap stocks. That's why we see the S&P at all-time highs. But the economy is actually very questionable, right? I mean, I think a lot of the numbers have been politicized, so it's really hard to kind of see the forest through the trees. But never forget, we're at the super high peak in market history. And what I want to do is show you a slide that I like to show all the time. This is the S&P 500. What this is going to do is kind of put into perspective. What the S&P 500 slide is going to show you is exactly how high we are today. Now, a lot of times people will say, hey, I'm waiting for the market to come back, then I'm going to sell. Well, we're on the far right here. We are basically at the highest point in market history, plus or minus a couple points. So just understand, we don't believe the market's going to continue for another 12 years. We believe we're closer to the end of this market than we are to the beginning of it. And, now it's time to start making some real decisions as to, what you're doing. So not only are we at the highest stock market in history, plus or minus a few points, we're actually at the lowest interest rate environment as well in history. And let me show you the 10-year Treasury. And what that does, it presents a whole nother set of risks. Now, the issue with being at such a low interest rate environment here historically is that what people had done in the past is they would put their assets into bonds as kind of their safety hedge. Okay. Well, right now, I would just ask the question: does it make sense for a 2% bond to commit yourself for a decade or 15 years? To a 2 or 3% bond when interest rates are rising pretty quickly, pretty substantially? I would say probably not. Oftentimes the devaluation of those bonds as interest rates increase could offset any of the yield that you gain, especially if you need to redeem that bond before maturity. Not only are interest rates low, stock market high, but we're basically leaving one of the most efficient tax windows in history here. A lot of people don't, realize how good we've had it in this tax environment. It didn't just benefit the wealthy. Most of Americans benefited pretty substantially from the Trump tax cuts. And as that starts to change here, with all of the Biden tax plans, that's another headwind. We've had all these tailwinds to help us, in the market here. And what that's done is it's given a lot of individual investors that have day traded on their accounts this kind of false sense of comfort that, hey, all you have to do is put it in QQQ and, IVV or the S&P 500 and just let it sit there and run. Well, for those of you that are going to retire in the next decade, does it really make sense? One of those charts I showed you earlier, basically, let me pull up that S&P 500 one more time. I'm testing our director and producer here, Randy, to the limits here. But if you see that first hump on the left there, that was a peak in 2000. The second one was a peak in 2008. But if you take a look from 2000 to 2013, the S&P 500 basically made nothing. So does it make sense to be able to, take those kind of massive hits? In 2000, we saw a 50+% drop. Same thing in 2008. I would just ask the question, what if the stock market drops 50% today, and you're invested entirely in that. Are you comfortable taking that kind of a loss? There's no right or wrong answer, Randy. Some people can tolerate because they've got another 20 years to work, but if they're going to be retiring in the next 7 or 8 years, I would really start, taking a look at your portfolio to really, stress test it to see if it can handle those kind of downsides.
Right, right. Stewart, you explain why it's the most tax efficient time in history right now.
Yeah, the reality is this, that, we've been given a lot of tools. A lot of those tools are being taken away. Like the Roth is in jeopardy, obviously. We've said before, make sure you call your senator, Sinema. She's done a great job historically of kind of fighting the good fight, but it's really important to make sure she helps, stand up and protects, all of our tools, because she really is one of the last people that is making these choices of whether or not we have a Roth. So if Roth conversion isn't available, towards the end of this year, honestly, she's one to blame. She's the one I would put it on. She's done a great job. Didn't vote for her, but I actually think she's great. I've had meetings with her staff back in D.C. They're great. They're informed. They know the state very well. But this is a crucial fight for my audience to really, fight on behalf of their rights for these kind of tax planning options. But, taxes are low. They're not just low for the wealthy. They're low all the way down to the 10% bracket. So I think it's really important to make sure you take advantage of that if it's still available.
If someone's watching and they don't know what a Roth is, can you explain that further?
Yeah, of course. So what a Roth is, first let me tell you what a regular IRA or a 401k is. An IRA or 401k, you get a tax deduction for putting the money away. So, as you know, I run a tax office, and, when you're meeting with your tax person, oftentimes you'll say, hey, you know what, if you put $2,500 away, you'll save $800 in tax. Don't you want to save $800 today by putting $2,500 away or $3,000? And you'll say, well, yeah, of course, it sounds like a great deal. What you're not realizing is you're building a tax time bomb for retirement. When you contribute to a Roth, you don't get a tax deduction, but all the future growth and principal is tax-free. The reason that's important is because when you retire, you have other income streams that come in. There are things like Social Security, for example. Social Security was never intended to be taxable. When Franklin Delano Roosevelt created it during the New Deal, he said it would never be a revenue source for taxation. But believe it or not, it was Ronald Reagan that made it taxable for the first time. And then Bill Clinton made it more taxable, up to 85% taxable. And that's all dependent on your income, on your taxable income, which is known as provisional income. So the goal in retirement is to create this efficient structure so you don't pay taxes on income streams that you don't need to. And you don't pay taxes on things like Medicare. There's penalties under something called IRMA, which is basically right at the top of the 22% bracket that, once you start making more than a certain amount, you're now going to have to pay Medicare penalties. And if you have a Roth, it doesn't add to that currently, any of those penalties.
Stewart, I learned so much on your show. Thank you. Yeah. This is a great time to go ahead and open up the phone lines and tell the viewers about your special offer today.
Yeah, absolutely. So what we can do is if you give us a call at 833-652-7829, or you click on the QR code on your screen there, what it'll do, that'll take you to apsitaxes.com. That's our website where you can sign up for a complimentary portfolio review. In that complimentary portfolio review, what we'll talk about is what kind of risks do you have in your portfolio? What kind of tax implications are we seeing in there? And what kind of fees are you paying? If you can't answer what kind of fees you pay to your current advisor, that's a big problem. You should give us a call, 833-652-7829, or go to apsitaxes.com. We'd be glad to help.
Thank you so much, Stewart. To the viewers at home, the phone lines are now open. Please do give us a call. That number is right on your screen, 833-652-7829. We're going to take a very short commercial break, but please stay tuned because when we come back, we're going to talk about how you can protect yourself against a downturn.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old they've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
Welcome back to the Asset Preservation Hour. I'm your host, Randy Major. Joining me today is Stewart Willis from Asset Preservation, Tax and Retirement Services. Hi, Stewart.
I'm going to shorten the name. I'm going to cut it in half.
That would be great. Thanks. Okay, so we're talking about the market volatility, and we really need to know how to protect ourselves. What do we do to, what strategies do you use to protect us from a downturn?
Yeah, well, so we know the downturn's coming, right? It's just part of what happens. And I think the one thing to do is, first of all, is to know your options. One of those things we tell people about is, first of all, is to take advantage of their age 59 and a half distributions that they're allowed if they're still working and they're scared that in their 401k they don't have proper management. Now, there's some downsides to that. We've talked about that before. But number one, know your options. Number two, and I think maybe the most importantly, is diversification. Now, I think diversification is misunderstood. A lot of times I have clients that'll come in with these huge portfolios. They'll come in with $3, $4, $5, $10 million portfolios, and they'll have 150 different positions in there and just so, proud of their diversification. But once we put that through our software and we really test it, oftentimes there's tons of overlap. A lot of times if you buy 3 different funds from 3 different companies, but they all buy the exact same underlying stock, they're doing the same exact thing. So there's not really any real diversification, is there, Randy? You asking me? I don't know. So, no, right? I mean, at the end of the day, diversification of investments is a really important thing. Number two, I think it's important to have a diversification of perspectives. Now, diversification of perspectives is something I've been really talking about. If you're talking to a financial advisor and the guy sitting across the desk from you is the one picking all of your funds for you, to me, that's a pretty big mistake. I think it's a very big mistake because your entire life savings is resting on whether or not they see the world correctly. I also talk about the fact that, let's flash back to November of 2020 during the election, right? If you watched Fox News, for example, or another news channel, you saw the world drastically differently, right? Your news source is completely guiding the way you see the world. And the problem with that is that that 2 different smart people can see the world drastically differently. Going into the election, we had one of our money managers that basically was concerned that, we saw 2 down months in a row, down 4.5%. And a lot of people believe that, hey, if Biden won, the markets could crash. And, because of higher taxes, higher regulation, all the kind of stuff we talk about on the show. We had another money manager who's, the biggest money manager in the world, and they saw it completely differently. They actually, thought that no, if Biden won, the market would do well. So they actually hit the gas and got more aggressive. And guess what? The market did fine. It actually benefited, from Biden being in the office, contrary to half of America's position, right? So what if one of those two people gets it wrong, as they did? Well, you don't want all your eggs in one basket. You need to make sure that your money manager, your financial advisor, has multiple points of view being reflected, not just their big box company's point of view, if that makes any sense. So diversification of perspectives is very important. Also, a diversification of tax classes. This all goes back to what we talk about when we talk about IRAs versus Roths. You need to make sure that all your eggs aren't in one basket in one tax class. You need to make sure that you have some non-qualified funds, some funds that you can access before you're 59 and a half years old, as well as those retirement accounts, the IRAs, the Roths, the 401ks. You need to make sure you have a little bit in each of those different buckets.
Now, Stewart, earlier you said the word recession, and that just sounds really scary to me.
Well, Randy, it's just part of the natural economic cycle. It's nothing to be scared of. It's just really important to make sure you have a plan. And I think one way that you can guard against that is not just diversification, but also make sure that you realize that if you have a passive approach, and there are some big companies out there locally with some great names that have, are known for low cost, index funds. And those have done brilliantly for the last 12 years. But what happens when the market takes a 50% drop like it did in 2000 and 2008, twice, right, in the last 15 years? Are you comfortable taking that kind of loss? Because, most people aren't. What we've done to combat that issue is we don't just take passive approaches. We also take very tactical approaches and strategic approaches. What I'm going to do is pull on the screen here a slide that's going to show a passive approach. This passive approach is basically normal, portfolio modeling, which is like on the left is for a young investor, 80% equities, 20% stocks. And as it moves further to the right, the equity position shrinks and the cash and bond positions increase. That's what most, target date funds do. If you look at your 401k and you see a target date fund, or you see most classical asset allocation models that are passive, they follow this model. And I'll tell you, Randy, that's not all that we do at Asset Preservation. That can be a part of it. But what we also look at is a more tactical approach. And let me pull up our tactical slides here. One of our asset managers here has identified 6 distinct stages in the economic cycle. And I would ask myself, if I were you, where do you think we are in here? Most people believe we're kind of, in that peak there, heading into recession. And there are different investments that do well. For example, when you backtest our algorithm money manager through 2008, we actually show highly positive results despite a 52% loss in the market in our backtest. Why? It's because there were investment classes that actually made money during the market downturn. And so if you are in the same investments you were during the peak of the bull market, that's a mistake in my opinion. Unless you just have 30 years to work, you don't care. You've got so much money that you don't care about watching it drop temporarily for the next few years. Well, that's one thing. But if you're nearing retirement and know that you wouldn't be comfortable with a 50% loss in your market, I would absolutely take a look at what kind of risks you're taking. And what we're offering the audience today is a complimentary portfolio review. In that complimentary portfolio review, what we'll do is we'll take a look at what kind of risks you're taking, what kind of downside is potential in your portfolio, and we will actually stress test that against 2000 and 2008 to see what would happen in your existing portfolio if those situations were to revisit us. We'll also look at any tax implications as well as any of those hidden fees. But you have to take action today. Give us a call at 833-652-7829. or you can click on this QR code on our screen right there. That'll take you to apsitaxes.com. We'd be glad to give you a second opinion. And like my good buddy Brian Corwanto says out of Pennsylvania, he says you can't get a second opinion from the guy who gave you the first. We'd be glad to let you know if you're on the right track or not.
Absolutely.
Just take action.
So important to know what you're dealing with, especially now more than ever. To the viewers at home, we have to take a very short commercial break. We encourage you to stay with us. The number is on your screen, 833-652-7829. We will be right back.
This is the story of how you get from here to there. Right now you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
Welcome back to the Asset Preservation Hour. Having a great show today, and the phone lines are lit up. We're getting so many great calls and so many great questions, and Stewart's going to answer some of those for us right now. Are you ready, Stu?
Let's do it.
Okay, this one's long. So Gene in Tempe called in, and he said, I have two retirement accounts. One that is in my main account that I'm contributing to and on track for retirement, but I also have another IRA from a previous employer worth about $330,000. I'd like to cash that out and buy an investment property, but I'm not sure about the taxes and penalties. I don't want a huge tax bill at the end of the year. I'm currently in the 28% tax bracket with an AGI of $250,000. What should I do to minimize losing money?
Well, I try to take a few notes there, and the one thing is they say they're in the 28% bracket, so I want to break some news to you. There is no 28% bracket. You may have a 28% effective tax rate, but there's a 22, 24, and 32. So it's probably somewhere in between. That means they're probably touching the 32%. But that's a big tax to be taking. And so if you add some additional income, if you take 300 grand out of there, now you're going to jump to the 35 or 37% bracket. I'd say that's a big tax hit. Oftentimes, unless you're finding a tremendous deal on this property, and when I say a deal, most people, when it comes to real estate, realize that wealth isn't built on the selling of your property, it's built, on the purchase. So, it's about finding great deals. And I certainly don't know that taking a massive tax hit like that would make sense, because what we do at Asset Preservation is try to, pull that out over time, to pull right at the top of your bracket, if that makes sense. But in this situation, I would say that, doing a big lump sum out of an IRA, to a piece of real estate is probably not advisable in this environment.
And let's talk about real estate for a minute. Is that something, in how we are right now in our economy, a good idea to be playing around with? Or
I can tell you this: some of our greatest clients, their wealth was built on real estate, and I like real estate. I think I don't know if it's going to continue to rise the way it is. In this low interest rate environment, just realize that property prices are driven by a couple things. Number one, demand. Number two, interest rates. So the demand keeps coming. So long as California keeps having their horrendous management of their state, people are going to keep flocking over here to Arizona. It's a great place to live. But with interest rates as low as they are as well, what we've done is made mortgages really low in terms of their servicing cost, right? So, values of homes are determined by how much those mortgages cost. Not everybody has big cash amounts to buy their house in cash, especially at today's prices. So as interest rates rise, I do have a fear that it's going to put some pressure on properties. We've started to see, these very aggressive prices come down a little bit here when it comes to real estate, but who knows? It may be, transitory. It may continue, but you don't want to have all your eggs in one basket. Randy, your question is pretty loaded here, but to get more into it, real estate is very efficient for those that have commercial properties or that rent out their properties, because what it also allows you to do currently is depreciate your property over 27 years. So the income you have coming in is being offset by the depreciation. So oftentimes we have clients that see losses in real estate, despite having positive cash flow. So, I love it. I love real estate as part of your portfolio.
All right, good information. Okay, one more from Daniel in Scottsdale. He says, I've always had fun researching and then buying and selling stocks as a hobby. However, my wife isn't too thrilled about me continuing this hobby as we get closer to retirement. It's only a couple years away now. Any advice on a way for us to find some middle ground here?
Yeah, it's if you want to gamble, take some of your money down to the casino or go with me to Vegas for the weekend. Don't bet. I'm just looking for a free pass to Vegas. That's all I'm looking for. But no, listen, don't bet your entire life savings on your picks in the market. You really have to have a reality check of what your skill set is. And I've showed you that S&P 500 slide multiple times. From the down or the trough in 2009, the market has multiplied 600% since then. So when I say a blind chicken could pick a good stock and make money, listen, everybody's made money for the last decade, or you've done a really bad job. But that's given people a false sense of security. I was raised in San Diego. And we have this great company locally called Qualcomm. It's a phenomenal company. And I remember my mom, decided to buy one of these stocks in 1999. And, she put $20,000 into it. And at the time, that was a lot of money for her. But her $20,000 turned into $25,000, and then it turned into about $6,000. And that's the story of janitors becoming multimillionaires and retiring. And then after 2000 and the crash, those janitors became janitors again, after they had all their eggs in one basket and everything was rested on the success of this one stock. I would just say, have a grasp of reality to understand whether or not you really understand. Don't have all your eggs in one basket. And I think the happy middle ground there is to say, hey, if you've got a $500,000 stake, maybe you're playing with $100,000, but have the other 4 professionally managed. And we'd be glad to help and take a second look at whether or not we think you're taking too much risk.
And so important for he to come in with his wife and then to meet with you and be on the same page, right?
Oh yeah, if you want to see the Jerry Springer show, come into my office here, because it's awesome. There's some pretty good arguments in there. But no, it's I think it's really important to have a second opinion to make sure you put your retirement into perspective.
Okay, Stewart, we're at the end of the show already. Let's quickly remind the viewers of the offer.
Yeah, if you give us a call at 833-652-7829, I'll tell you whether your wife is right or not, or whether you're an amazing stock picker, but you have to take action. Give us a call at 833-652-7829 or click on that QR code. We'd be glad to help.
Thank you, Stewart. To the viewers at home, thank you for joining us. We hope you have a beautiful rest of your day.